Well, as Jerome Powell and the Federal Reserve push back against some of the pricing around a March rate cut, we're starting to see US regional bank concerns raise their head once again. But can it last, or is this an idiosyncratic situation? Mega cap tech earnings are rolling in. Google certainly weighing on the tape. But in the session ahead, we have Apple, Amazon, and Meta. Equity markets are all-time highs. They're not a million miles away from there, but a few dark clouds seem to be circling around those markets. And Blake and I discuss and assess all of those factors in the trade-off today. Well, hi, I'm Chris Weston. I'm going to be joined in 2 seconds by Blake Morrow. And the tides of change potentially are upon us. We'll have to see. We'll have to look at the situations that are unfolding. There's been a risk plethora of recently that's been going through markets, but things potentially could be changing. We'll have to look at that with Blake today. So Blake, come into the program. There's a lot to discuss, as there always is. You know, if you can't find something to talk about in these markets, obviously you're not looking hard enough. We're mostly focused on the trades and the price action more than the actual narrative necessarily. But there's a lot going on at the moment. How are you sort of seeing all of that aggregate tape at the moment?
Well, Chris, today was obviously, I actually feel pretty worn out. It's at the end of the day, a lot of data thrown out at us, a lot of moves in the market, and a lot of really great setups that are we're going to be, obviously pulling your way. But I'll tell you, this risk rally looks a little suspect at this point, and I'm fearful that if the S&P goes much further, we might have a little bit of problem with sentiment and setting up in the markets. But the pushback from the Fed chair didn't really surprise us. It didn't surprise me a whole lot. I mean, and us, I want to say us here at the Trade-Off Show, we've talked a lot about it over the last couple of weeks. The rate cut expectations going into this year were just a little rambunctious. And I think, the pushback, as you pointed out, rambunctious. Yes, rambunctious. But, the pushback, as you pointed out with Fed Chair Powell, I think it was warranted, and how the markets respond between now and the non-farm payroll is going to be really, really critical, in my opinion.
I just think that there's people out there hoping for a pullback. But this is a fickle market, and all the news flow we've just seen there could change, and people could be buying dips in this market because they're seeing things in a different lens in 24 hours. So we'll have to look at those situations, and I think it's probably a good place to go straight into it. Let's go topical thunder and actually assess all of those parameters. Yeah, let's go straight into the Fed, Blake. It's obviously the topic du jour. I think there's other factors in play that came just before the Fed meeting, which we saw the employment cost index sort of annualizing at 3.5%, 90 basis points, and that impacted lower ADP. And of course, we've got the New York Community Bank, which is getting sort of heavily debated, and that's the equity was absolutely taken to the cleaners, and rightly so when you see those loan loss provisions picking up substantially. But in terms of the Fed meeting, I think there was 3 distinct stages to me. The first one was the statement, which was considered to be hawkish. Then we saw Jerome Powell stepping up, and we had a bit of a bounce in risk assets. He talked about restrictive territory that they're in, highly restricted territory, and that they'd look to pare back the target range at some stage. But then towards the latter stages of the conference, he then said that we're pushing back on the March hike. They're putting everything on inflation. They want to get it down to 2%, not just in terms of tradables and goods, but the whole basket, the whole area of core PCE. And then obviously that sort of just impacted the tape again. So I think I'd coin them in 3 distinct stages of the Fed meeting. The wash up is that we've got yields lower, equities very, very heavy. But a lot of that was going into there. So how are you sensing? We can talk about the Fed all day long, but just give us in a nutshell, what does this mean?
Well, you're right. When towards the end of the press conference, when he was asked about March, and he said that it doesn't seem like, based on what we have right now, it's not likely that we're gonna be cutting in March. When those words came out, that was that that wave of dollar buying. But what's really interesting, Chris, and I say dollar buying, and stocks slumped to lows. What's really interesting is you look at the bond market. Bonds are stronger. You look at the 10-year, 30-year. Yields were down. Dollar was strong, and I don't know if that was a result of maybe some risk off buying. I'm not really too sure, but that mix that where you have dollar stronger, yields coming down, that does make me concerned. I say concerned. I just pause a little bit before I get too aggressively bullish the dollar. And I think the market was doing that too. I mean, you see the market and the price action of the euro. We stalled at 108, which is pretty critical support as far as I'm concerned. The market kind of paused as well because they're like, how are we going to read this? But basically, that pushback that we got from the Fed, I think really, has the market readjusting, because going into the press conference, it was still more 50-50 that we were going to get a cut in March. But at the end of the press conference, interest rate pricing is showing that now we're seeing it start in May, not in March for a rate cut.
We've got 35% for March, I think. Yeah, so May is where you're looking, isn't it? So
Filtered,
I think that's fair. I think that's fair. I mean, what have we got? We've got a CPI number on the 13th of February. That be influencing the 1st of March. We've got the core PCE number. But remember that the Fed want to have real confidence in that inflation number. And given the data flow until March, on the 20th of March, the FOMC meeting, have they got enough data points to justify what they consider to be confidence? I'm not so sure. So I am in the camp right now, unless we do see a pickup in inflation, which is the biggest risk to markets, that they go in May. And I think the interest rate pricing is there. That's enough data, especially inflation data and jobs data, to give them that confidence, I think. So May is my sort of default situation now.
Well, okay, without going too deep into this, and I know we're going to go into some technical charts, May, does that mean S&P 4,800, 5,000, or 4,700? That's the question, right? That's like that's it.
Well, you've got to look at what's it's not just about the lift-off date or the start cutting date, but it's how many. Yeah, it's the pace of rate cuts going into the end of the year. I think that's also really important as well, and why those rate cuts are being there. The market loves the idea that inflation's coming down to target, or it looks like it's coming down to target, while growth's relatively supportive and positive. The consumer in the US is still very, very strong. But if rate cuts are coming down because people are starting to rise inflation, recession risk, then that's a whole different beast. So at the moment, we've got this soft landing in play, and that's very supportive of buying dips in the market. But if we were to see the consumer waning, then that's a whole different ballgame. We can start talking about 50 basis point cut increments, but that's not where we are at the moment.
Yeah. All right. Well, let's move on, because, Chris, sometimes on this show, we get wrapped up into what's happening in the U.S. And, I first really realized how important the U.S. was when I went to Greece, and I got married in Greece in 2002. I had to think about that for a second. In 2003. I'm sorry, I got married in Greece. And then you sit around, you talk to all these Europeans, and they're like, "Yeah, we have to pay attention to what's happening to you," and because you're driving a lot of the world economy. And so a lot of times here on the show, we tend to do that. But today, we really need to talk about other FX moves that are percolating in the market. And I want to really discuss what's happening with tomorrow. Tomorrow, we have the Bank of England. And the Bank of England, if you look at Sterling's held up really, really well. And I'm not sure if any of Sterling charts are going to pop up for you today. I didn't bring any to the table, but we're in this tight range between basically 126 and 127.80.
Everyone's talking about that range at the moment.
It's so. I mean, we've been talking about it for weeks at the Forex analytics community, but it's just like gone on. We're like, okay, any day we want to break, and I'm sure a lot of people have too. But the fringes of those ranges can be tested. But it's not just pound dollar. We've got a really big breakdown in the euro sterling as we're approaching the 85 pence level. Some of the pound crosses look pretty bullish. So, between that and some European data that's coming out tomorrow, how are you treating the rest of the FX world going into, and then on top of that, you've got some of these yen pairs that are starting to gain some strength as the Nikkei might look a little.
Oh,
peaky.
mate, we need longer than 3 minutes for this section, to be honest. I mean, we have the whole day. Look, I think yen's looking pretty interesting. Got some charts around that. I'm not expecting the Bank of England meeting to be a volatility event per se, but I think this defined range is something that we look to continue trading. What I'm really looking at in the session ahead, Blake, is the European CPI numbers. I mean, we're expecting core to be at 3.2%. But if we were to see a two handle, say below 3%, I think that would be very meaningful indeed. And we're expecting headline the estimate. This is the first one to come out 2.8%. But the ECB, Lagarde refrained from really pushing back against market pricing in last week's ECB meeting. There are some of the doves who are talking about rate cuts at the moment. Obviously, the hawks are going against that. But I think if we were to see a core inflation number with a two handle, that would probably say to me that the ECB must be the candidate to ease policy before anyone else, maybe the Canadians, but certainly I think this ECB inflation number I think is really meaningful. And then you're going to see that euro sterling break those lows. Euro yen looks like it's right for the downside. Obviously, if we get a big number above expectations, then all of this is untrue. But where we're seeing inflation in the US, in Australia, they're missing. They're consistently coming out below estimates at the moment. So I think that's the big one there as well. But I think euro sterling through those lows. Euro yen looks interesting. Euro Kiwi to an extent has been a crowd pleaser recently. So I think that Euro CPI number. I'm gonna go over time and I'm going to pass it back to you and give you the opportunity to reply on that as well.
Well, I think our setups are going to speak for themselves as we talk about them today. But I do agree with you. The euro looks vulnerable, and it's not just euro sterling. I mean, it's euro. Yeah, as you pointed out, the euro yen it broke down today. Broke down pretty aggressively too. So, and I think we're testing the 50 DMA if my memory serves me correctly. So I think that there's a lot going on in the FX market, and that's a great thing for us as traders. There's a lot of opportunity as there's a lot of volatility.
I just want to say one thing. We go into the next one. The race to be the first central bank to cut, I think, is so meaningful. The Fed have pushed back rate pricing. The RBA are trying. The RBNZ are trying. The Bank of England are going to retain their kind of hawkish bias and push back against market pricing. If we get a weak CPI number in Europe, then market will say probably the ECB are going to be the first off the rank. I think the first central bank to cut will be very meaningful indeed, and I think you're going to see flows dictate that. So that's the interesting one there as well. Anyway, Blake, let's go to the Nasdaq because Google came out with some earnings which I thought were pretty good, but there's a lot in there that the market really was displeased with. The stock was down 7%, and that's obviously weighed very heavily on the Nasdaq. There's other stocks involved in there as well. Microsoft, which was very, very good earnings, but they weren't good enough, and the stock's down hard. And obviously that's got the biggest weighting on the Nasdaq and the S&P. In the session ahead, we've got Apple. I don't think Apple's particularly much of a market darling. Obviously, sentiment towards China is poor, but we do have Amazon and Meta, and they definitely are market darlings. They are buy-side favourites. They are heavily owned, both of those stocks. Everyone owns those stocks in the buy side. And if they don't blow the lights out, then we could be looking at another drawdown coming through the Nasdaq. So you've got I think real rates are supporting equity markets. They've been coming down. A bit of a pushback from the Fed is not great. But I think these earnings do matter. We talked about them last week, but it's pretty clear, momentum names like Meta, they have to just blow the lights out. When they're priced to perfection like this, they have to absolutely knock it out the park. So the tolerance for any miss is very poor. You're going to see a 5, 6, 7% miss downside move in the Nasdaq there. So are you expecting further drawdown in the Nasdaq? Would you be looking at hedging strategies? What are you looking here?
I think one of the bigger stories is the Mag 7 not being so magnificent over the course of the last. I had to do it. I'm sorry. But the Mag 7 has been kind of underperforming, and this is the key, Chris, is this market has been very good about distribution. So you have one one market or one section of the market, taking the reins. It's like a relay race. The relay passes over. Next thing you know, you got another sector of the market taking hold. And right now, you're right. The NASDAQ is a little bit at risk. I do look at stocks like, especially we have Apple. Apple looks well. Stick around because we're going to talk a little bit more about Apple. We've got Apple. We got Amazon that's really lacking here. And as you pointed out, Meta. Microsoft is. Although ripping to all-time highs or has been, it looks a little frothy. So I'm skeptical, and I think I'm going to be more skeptical, Chris, not necessarily because of what the NASDAQ is doing, but I'm going to be looking at the broad markets. I really have my eye on 4820 on the S&P or 4,800. Depends if you're looking at the futures or if you're looking at like a CFD, right around the previous all-time highs. That level has to hold. It just does. And if that breaks down and you're out there buying NASDAQ as the S&P, the broad market's breaking down, I think that's a mistake. So
I just want to quickly go into this one.
Yeah.
Right. Tech aside, we did see New York Community Bank Corp coming out with this $552 billion loan loss provision. They cut their dividend, not completely erased it, but the market's saying, what's going on here? With the bank term funding facility being rolled off in March. We've just seen the KRE regional bank index down over 5%. It's been an absolute bloodbath here, and people are saying that we could see a re-emergence of regional bank concerns. I'm not an equity analyst per se. I have been speaking to people, and they say this is a purely idiosyncratic event to New York, but the market's saying, they've taken it to regional banks. So is it time to put the regional banks back on the radar ahead of this roll-off of the bank term funding facility? Could we be seeing something that actually promotes the Fed to cut rates sooner to support these entities? So
first of all, I don't trade them either. I'm not an equity analyst, but I am of the school of thought and the school of trading that sectors or assets that underperform where they should be performing are suspect if the whole market turns lower. This is why I had a lot of pushback at the end of the year as we were doing some of these shows, our end of the year show, when analysts are talking about the Russell 2000, taking the reins and breaking out. I'm like, I just don't see that. And so when you look at the KRE, and that is worrisome. What was it down today? Like 5.6%
or something? Yeah.
Okay. Well, we'll just call it. I said 5 to 6%, 5.6. That's fine. I mean, it is a concern, right? So I think that you have to look at these sectors of the market that didn't perform well as stocks traded all-time highs. I've been through so many bear markets over the years, Chris, that those are the ones that tend to get blasted first. Sectors, stocks, anything that's underperforming in a good market like we're seeing right now.
Yeah.
So,
I definitely think you've got to keep it on the radar. I think that if the KRE moves lower, then let's move on.
Okay, let's move on, and let's move over to the big event risk. I say the big event risk. We talked about the Bank of England European CPI tomorrow, but Friday we have the jobs report, and I want to talk a little bit about the jobs report because I want to talk about what's your playbook here because. It's a little mixed to me when you're talking about the playbook. Could be because, first of all, let's talk about the ADP data. It came in 107,000, worse than expected. The market was expecting 148,000. Last week, unemployment claims, they look like they were, we look like we were going to get a foothold below 200,000. Last week popped back up at, I think we came in at 214,000. But you look at the JOLTS numbers that came in yesterday, there's jobs aplenty. May not be the best jobs in the world, but jobs aplenty. So little mixed as far as, what the market's expecting. I think you could just throw a dart at a dartboard and figure out what NFP is. It's your guess is probably better than mine, you guys listening in at home. But I know what I want to play. And I know what I want to play in a strong with strong data or weak data. And so when I'm looking at the non-farm payroll, I'm now in the camp that if we have data that's better than expected, okay, it's better than expected, the stock market will have limited upside because of today's FOMC meeting. So if you see a move higher in equities because everybody goes, yay, strong number, don't forget that's one of the reasons, even though the Fed Powell said labor market is rebalancing, whatever the hell that meant, I'm really not too sure. But if we get a strong number, he's still looking at labor. He's still looking at the jobs market. Strong data means he can push back even further. So any rally in equities, I think, is going to be met with selling. Flip side to that is if the data comes in is a little weaker than expected, I do want to short dollars. If it comes in too weak, which I'm not expecting, but let's say U.S. didn't create any jobs this month, the market may come under assault. And we could really see some downside pressure because then recession fears would be more of a risk. But what are your thoughts about NFP and how are you going to play it?
Well, I think it's too difficult, to be honest. Does the market look at the headline number of jobs created? Does it look at the unemployment rate? Does it look at the average hourly earnings? If you had to pick one, I'm going to go with the unemployment rate. I think that's probably what matters the most to the market. I think. Yeah, the market's expecting a little bit of a push higher. They're based on different surveys. You've got the establishment survey and the household survey. So you can't say, we've seen a strong level of jobs in the establishment survey, and it doesn't read through into the unemployment rate. So I think the market will look at the unemployment rate. I think if we were to set, the concern here is that we get a re-establishment of inflation. I think that is the biggest risk to markets going forward. Whilst the labour market doesn't necessarily mean we're going to get that, I think the market wants to see a cooling. We didn't get that in the jolts. We got the opposite. So that muddies the water. I think that the playbook then, very simplistically, if we use that unemployment rate, if we were to get above 3.8%, then that will be weakening of the dollar. That does bring March back to about a 50-50, I think, from around 36% at the moment, a March cut. Although I think March is still not my base case. May is probably where I'm at. I think an unemployment rate above 3.8% and it brings a March cut to probably about 50-50. Could you imagine
if it was a four handle?
Oh, well then, yeah, obviously that would, obviously we have to look at other factors like average hourly earnings and the household survey, it can be notoriously volatile and there can be reasons behind that. But yeah, if we were to see, a really low level of jobs created, obviously that's going to be negative for the dollar. But I think that unemployment rate is really what you want to be looking at. I think if we were to get, if we were to see 3.7 or even below that level, then that would be positive for the US dollar. I think dollar yen would spike up, yields would move up a little bit there, and I think that pricing for March would probably come down to about 25% or so. So an interesting one, but I do think it has bearing. I think anything to do with inflation, anything to do with the labour market is what the Fed's looking here very, very closely, and the market is really sensitive to that. So yeah, do put it on the radar. It's something that it's a risk event, and you need to monitor your exposures over it. So obviously look at that very closely. Anyway, let's go into the charts that matter. Let's go to That's a Setup. Right, I'm going to bring dollar yen up straight away because if we have a look at the daily chart of dollar yen, I mean, it was looking pretty dark at one stage, and certainly the yen crosses have seen a bit of, the yen has seen a bit of love against some of the other crosses, certainly against the Aussie and the Kiwi. But you can see here that we had a really nice move lower. The buyers have stepped back in. We've got a bit of a fat tail coming through there, big wick at the bottom. Good buying pressure as those dollars came back in. Dollar buyers came back in, a few shorts closed, but it still feels a bit heavy to me, Blake. We're still back in that sort of distribution, that consolidation zone that we've highlighted as the green level there. I was hoping we'd get a test of that 38.2% retracement level of the recent rally. Didn't happen. And there's big buying support, but I think those buyers will be caught offside soon. I do feel like the put a gun to my head, where's this probability? I think it goes lower personally. Obviously, payrolls is going to dictate that one as well. So, yeah, how are you playing? I'm only to bring up dollar yen. I know we could go through all the yen crosses, but I'm bringing up dollar yen because that's where we've seen the concentration of client flow coming through. So, how are you playing this?
I'm not playing the dollar yen. I was playing the dollar yen. I was playing it on the short side. I literally got out for, I don't know, it was like 20 pip loss after, I'm talking over the course of like 5 days. And, carry interest, started to weigh on me, and I'm just like, don't want it. But technically we have a bull flag pattern. That consolidation, it's slightly descending. That would be the flag. Okay. And I know it's not drawn here. I do think, though, on a strong number, the dollar yen rips higher. If it gets anywhere close to 150, I think it's going to fail. Matter of fact, right around the 150 is a long-term 78% retracement of that entire chart, basically, that you have displayed there. So I'm not bearish yet, and especially while it's above the 50 DMA, which comes in around 145.60 or so. As long as we're above that, it still looks constructive. But I agree with you; it's not trading well, and so if we saw the big 150 number, I might stick my neck out there and look for a trade short to just create a lower high overall.
The other thing to consider as well is this is these risk currencies. If the equity market does have another big drawdown, depending on what happens in earnings after market tomorrow, the yen's finding some love from that. The Swiss franc's working well. If you have a look at the daily chart of Swiss franc against the yen, it's just moving sideways. They're both safe haven currencies. We haven't seen a massive pickup in the VIX, and vol is generally still quite subdued. But yeah, I think if we were to see that play out, I'm not saying it's going to happen, but if we do, then the dollar, the Swiss franc, and the Japanese yen are your sort of go-to currencies in that world of high vol, risk drawdown. So do keep your eyes on credit spreads. Do keep your eyes on equity markets, because if this does turn out to not be a one-day affair, then the dollar will work on a selective basis against risk. The yen will work, and I think that's really, really important. Know your characteristics of your currency. If the equity market does pull back again, VIX goes into, say, 16, 17%, the yen's going to work, the Swiss franc's going to work, and the dollar's going to work there.
And that's a great point, Chris. And I must say that we haven't seen the yen respond to any risk off, but to that argument, we're sitting at all-time highs or close to in most markets. So there you go, right? We see a little bit of risk. The yen might actually respond, and I couldn't agree more. I'm going to take us over to Apple, and this is a great setup because it is the apple of my eye. Get it?
Oh, very nice.
Apple of my eye, like my kids. Anyway, showing the underperformance of Apple and how it's stalling. This still sets up as a bullish wedge. Now, a bullish wedge is when you have higher lows and consistent highs. Actually, that last high was not quite as high as the previous high. So some might argue, well, it's not a bullish wedge then. It's a wedge any which way you slice it. But what's really critical support here is the 200 DMA, which we're coming into. It comes in around 182.60 roughly. Below that is an ascending trend line, and then you have a 618. So around the 180 to 178 level. We start getting below 180. That's where I would be saying, okay, people are going to start throwing in the towel. I think you're going to start to see selling. You might get some systematic selling because you're below the 200 DMA, below the 180 level. That's when sellers might step in. But while we're above that, you're talking about buying dips, Chris. Look, Apple earnings are tomorrow, and they have to come in better. And this is your pivot. This is your setup, right around 180. So what are your thoughts here on Apple?
Well, you go back a couple of quarters, and this would have been the stock that everyone was focused on. But now I think the leadership's firmly more in your AI names, NVIDIA, your Microsofts, for example. But I think this is still really important given its market cap. I don't want to short it. I think it's hard to short, but I do think that 200-day moving average, so that rising uptrend is really important. And I guarantee you, if it breaks through those levels, you're going to see charts left, right, and center. Not just on social media and Twitter, but you're going to see the media talking about it quite a lot, because that's how important this stock has been historically to the market. And when we break through those levels, you are going to see headlines around Apple breaking down through trends and 200-day moving average. And so I do think psychologically it matters. So this is a setup. If we do see those earnings after market coming out below expectations, if it does miss the mark, if it doesn't give the outlook that the bulls desperately want to see, I think we come down to test those levels, and it's how markets react into that. That's obviously key, and I think the market will react on that. So this is a setup that I think is not just for equity traders, but I think more broadly for index traders. And if the index is moving, we just talked about what happens then with the yen. It just brings in a whole sort of suite of asset classes on there. So if you're trading the yen, if you're trading the dollar, trading gold, trading indices, get a little chart of Apple up in the corner and just keep a monitor on that, because I think it's going to be really important going forward there. So yeah, good one. I want to bring up a chart of the dollar index, or the Dixie, because Blake, you started talking about how you're starting to warm to it. But I mean, what we've seen recently is, we've had this sort of V-shaped bottom. Everyone loves a V-shaped bottom. We had a consolidation. We broke up to the upside. We're again just consolidating around the 200-day moving average. I think we've had about 8 or 9 sessions where it's just oscillated around that level. The bulls are trying to push it up. They're not getting their way. The bears are trying to do the same. And it's got this kind of battle going on. For me, you just take it to a 1 hour chart and you just trade the range. Lean into highs, lean into lows. And then when it breaks out, I feel like the probability is it breaks out to the upside. These things tend to sort of move, strength begets strength. So I favour, this breaking out to the upside. But there's a consolidation that's going on. And again, a lot of this is down to the euro and that euro CPI number in the session ahead. I think it's going to be really important to the dollar index here. And if we get a weak number, obviously Dixie breaks higher. How are you trading this? Do you like the probability of this going higher? Do you see that further sideways? How are you trading this?
Well, that lower box that you have is the right shoulder of an inverted head and shoulder pattern that we've been playing. Frustratingly, let me add that we've been long predominantly the dollar over the last 2 weeks, and it has not been an easy trade. Selling euro on rallies as it approaches 109 has been the play for most of us. Even today, we saw a move pre FOMC closer to, it was like 108.85. Many of us sold into it. So playing the dollar on the long side as it's an inverted head and shoulder pattern makes sense. Following the Fed and following the comments that pushback from the Federal Reserve Chairman does suggest that we are now headed to 104 to quite possibly 105, where we'd complete the inverted head and shoulder pattern. So to answer your question, simply put, I'm playing it to the long side. I'm going to continue to play on the long side while we remain above 102.75, 102.80.
With you. I see the risks. I mean, obviously, we don't know the future. No one does unless you're an insider trader. But I see I agree. I mean, I think if you're looking at the risk, when this breaks out, I see greater upside risk than downside risk going forward. So.
Well, let's take it over to the dollar mex, because that's going to be my final setup. And this is one, I know it's been on my radar for a while, and I've talked a little bit about it, Chris, but this is, to me, more the canary in the coal mine. We talked a lot about NASDAQ. Do we buy dips? S&P, 4,800, 4,820, very big levels. The biggest level for me in FX right now is dollar Mexican peso at the 200 DMA. We've rejected it a couple times, but we can't get below 17. So if you are a buyer of Mexican pesos, you're trying to play the carry trade, you're trying to play the emerging market carry, you're not getting paid other than carry because the thing is buoyant. So if we start breaking above the 200 DMA, I think it starts really challenging that trend line. And by the way, that trend line goes all the way back to post-COVID spike highs. So that's how important that trend line is. That comes in around 1780, 1783, also the 618 retracement. So I think it's a quick move. 1740, 1780, and then atmosphere levels. So, Chris, what do you think about the dollar mex?
I think it's interesting. I mean, again, a lot of this comes down to risk in the market. If we see, like we talked about the yen, if the equity market does find further sellers, and it's a big if it does, the vols equity vols pick up, FX vols pick up, and the Mexican peso is going to get sold because we see an unwind of carry positions. So I think that's really, really important. Dollar mex is going to absolutely fly if we were to see a further risk off kind of move. Another 2% move in the Nasdaq, not my base case, but if it does happen, then obviously dollar mex is going to break out of that 200-day moving average, and you've got your wish, you've got your move higher. Whether it's the canary in the coal mine is another factor. Yeah, maybe that along with factors, although the Aussie hasn't really been moving along with China for a while now. Which way does it break? I have no idea. But I do think that this is a policy of letting the market come to you. I have no position in this. I haven't looked at this chart for a while, but now I do. I'm going to watch it very closely because I think looking at this, it doesn't take much to see that if it breaks that 200-day moving average, and it depends what that break looks like, the sort of range expansion, the candle that we're seeing, the price action there. I think this has got some good upside. So, I think this is one that has to be on the radar. Whether this is the canary in the coal mine, I don't know. But if vols pick up and it breaks that 200-day moving average, I'll be looking at trading that from the long side for sure.
Yes, I got Chris getting on the long side of the dollar mix. I love it. I love
There
it.
you go.
Sold.
But yeah, look, I mean, yeah, there you go. I mean, I wouldn't be holding it for too long because there is obviously a carry component to that. But yeah, you don't need to be honest. But anyway, so that's an interesting one. Monitor that one. Stick that with your Apple chart and yeah, put a go onto TradingView, get your split screens and your multi charts there and monitor them. Yeah, put an alert on that, and when it breaks that, you get a little pop up, boom, 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 and you know you're on. So let's see what happens there. Anyway, let's go to play of the day. Play de jour. Well, I'm going to go for that cheeky Aussie yen position that I looked at there. So let's have a look at the daily chart on this one for oversight there. We've just seen a big move down about 1%. Now, obviously, yesterday we saw the Aussie CPI numbers, the Q4 numbers coming out. They were below expectations. We've obviously we've seen the December number, which is a slightly more sort of faster pace one. We're at 40 basis points now from the RBA's target if you were to use that 2 to 3% band. I think that, things are changing and evolving quite quickly in Australia. They've still only got just over 2 rate cuts being priced by the end of the year, which I think is okay. But I think the market is sort of starting to think about bringing that forward. And the market's responding. But again, we've seen a big move down. A lot of this is going to be determined by what happens in the NASDAQ going forward. If we do see Apple, Amazon, those kind of names beating expectations and NASDAQ are up 2%, Aussie yen's going to rally. There's no doubt about that. So look, we've seen a big move here. I like this from the short side, but I know that I'm looking to cut out as soon as we start seeing some good buying coming through in the NASDAQ. I'm out of this trade. I'm looking to do a sell stop order through those lows. So just I'm putting a sell stop below those lows, hoping for momentum. So it's a pure momentum trade. Get rate of change on there, and it breaks those lows. I'm filled, and I want to be losing the momentum in the market. So just putting a sell stop order through the red candles lows, hoping that that's going to continue going forward, and further sellers are going to take this one down into sort of 95 going forward.
Ooh, juicy! I like it, Chris. I like it. I like it when Chris gets on the sell side.
Okay. Go on. Tell me about your tell me about your Kiwi trade, bro.
Yeah. Okay. So my Kiwi trade is my play of the day, and I'm looking at the Kiwi obviously on the short side here, but it's got a nice bear flag pattern developing. And with the bear flag pattern developing, all I need is a daily close below the 200 DMA. I know there's a lot of support down there because we've probed it down around the 60, 50, 60, 60 level. But it doesn't matter to me. We get a daily close below the 200 DMA. I'm looking to press shorts. I am looking to get short, if not today, tomorrow. I'll probably do what Chris is doing, put in a sell order, sell stop below the market. But I am looking to play it to the short side, and I'm looking to add on daily closes below lows. So in other words, I'm chasing it lower because what I realized today, Kiwis don't fly. I had to confirm that, Chris. I had to confirm that the Kiwi bird does not fly. So one little piece of risk that you need to be paying attention to for next week. Next week, I think we have New Zealand employment on Tuesday, February 6th, or actually it would be February 7th on Wednesday for you guys. For me, it's the 6th on Tuesday. So
Could I just ask,
that's going to be the major event risk.
When you're talking about setups and technical patterns per se, I mean, everyone sort of, we always look at high probability setups, and I think you can backtest these setups. For me, the bear flag is one of the ones which I have highest conviction on. So I love those because when you're going in the flow, everything has a bit of a consolidation eventually. And when it breaks the downside, I'd say 80% of the time that it continues to go in that trajectory. So I think flag patterns for me, and I'll be interested to hear what people at home, but for you, Blake, I'm asking you, I think flag patterns are some of the best patterns. And when you get at the complete, when it actually closes below that level, I think that's a fantastic trade. I see a high probability that continues down, so I love that trade. Not that you should never love a trade, but I think that's a high probability setup.
So I have 2 favorite setups in my book, and for a continuation pattern, it is a flag pattern because a flag pattern, it shows that you can't get back below a 38% retracement, which means that any type of pullback is very shallow. That means that the buyers, or in a bull flag pattern or in a bear flag pattern, sellers are in control. But shows you how much control the market has, and they're going to continue to push that envelope in that direction. My other favorite pattern is a descending or ascending wedge, which shows the market has come to a top and then is reversing, or down, hit a low and is reversing. Those are my high probability reversal patterns. So yeah, you're speaking right up my alley, Chris, and I'm glad you brought them up. And we'd love to hear from you down in the comments below what your favorite technical patterns are.
Do it. Yeah, no, anyway, it's a good one. Thank you for that idea. I think you'll wait for the completion, and then I think that's a nice trade. I'll be looking at that one myself. Anyway, thank you, Blake. Thank you, everyone, for home. Lot going on in markets. Obviously, we went well over time today, but that's just a reflection of everything that's going on and so many talking points. We'd love to hear your views on markets. Leave them in the comments section. Give us a like if you can. We'd really appreciate that one. And we'll see you back next week for more of The Trade Off.